So good morning, everyone. I'm Chris Feeney. I'm the Executive Vice President at the Bank Policy Institute and President of BITS, which is their technology policy division. I've also been a lifelong technologist, so I've been on both sides of this partnership. And it's a really interesting time in the annals of partnership. As you saw in the first panel, the financial services firms have a certain demographic or footprint within cloud, for instance, but it's changing quickly. The velocity has changed quite a bit. The options to source versus build have changed dramatically. The advent of cloud in a meaningful way, and I think we're on the precipice of that as a financial industry, and the risks. All right, we'll talk a little bit about that, and it was mentioned in the last session, but cybersecurity risk, data protection, resiliency are all front and center. We have a great panel here today, a real mix. I think you'll appreciate that. We're going to discuss a number of things, the changes that are occurring in the partnership arena, the current state of partnering, the benefits and the risks of partnering, the future state of partnering. And we expect to leave about 10 or 15 minutes, if not more, for some Q&A at the end. So I'll bounce around because they're not in order the way they're written here, but we have Paul Gu from Upstart, Catherine Van Nuys, who's from AWS, who's in an interesting role as a business development role, Campbell Gibson from Avant, Scott Astrada, who's Director of Government and Community Relations at Affirm, Mike Kinane, who's from TD Bank, so we have our resident banker, thank you for joining, and Brian Martin, Head of Business Development at Blend. So I'm going to start and maybe give Paul a chance to really kick it off. You know, partnership's been around a long time, figuring out how to outsource, in-source, what you build, what you don't. But the world's changed a lot in the last 5 years. And the engagement and how you engage with partners has changed quite a bit. So, Paul, maybe you want to give us a little sense of what you're seeing and what it means for you guys.
Yeah, so just to give a little bit of background, we started out about 5 years ago in the personal loan space, mostly originating loans under the Upstart brand, but in partnership with a bank. But over the last few years, what we realized was that despite the great success we'd had doing that and the continued success, we really felt that in the long run, there were some fundamental disadvantages that we as a fintech lender would always have relative to banks. And those were two things primarily. The first was cost of funding, and the second was sort of existing customer relationships or sort of cross-sell potential. And that would always sort of put the end customer at a disadvantage because even if we could be much better at, say, underwriting, much more automated in the process, there would sort of always be something lost. And if you could put those two things together, the sort of best of banks and the best of tech, you'd get sort of the best product for the end consumer that would be sort of strictly better than what either in isolation could provide. And so starting about 2 years ago, we've started actually taking our entire technology platform and white labeling it for a number of banks to use. And so today we've got about almost 10 or so institutions that use our technology under their own brand. So it's originated either to their existing customers or to the, new customers under their name. And using, of course, their balance sheets. So that's sort of how our model has changed. And increasingly, in general, we're kind of seeing that, especially small and mid-sized banks that see that sort of technology change is coming, but don't necessarily want to or are able to invest fully in that technology, partnering with fintech companies to make it happen.
Great, thank you. So, Mike, you've seen partnering change quite a bit. How do you view this as a bank, and why is the willingness to partner changing? I mean, there's a business model example, but...
Yeah, sure. In a use case, Paul, every word Paul said, I would echo. I think from our side, it's a speed to market question, as well as an expense question, and ultimately, it's a customer experience question. So if we can answer those three things, we'd love to do it all internally, but the problem is, we've got legacy systems, we've got legacy decision-making that doesn't always facilitate a speed to market or the best customer experience. So for us, it was answering those kinds of questions internally. Once we decided, it was probably either too expensive or it took us too long to do something, then it was, it pointed to the partnership conversation. And with partnerships, a vast array of partnerships, all great, especially represented on this panel. But you need to, at least we needed to make sure we felt comfortable with them from a cultural standpoint. They could make sure that our customer experience was what we want for our 8 million TD Bank customers in the U.S. And we wanted to make sure that they were also safe and sound, the compliance and regulatory items were met, and a lot of control, obviously, being a partner for a regional bank or super regional bank for us.
Catherine, a little different setup, right? With AWS in your role, you've actually developed a business line around partnering, which I think would be interesting for the group to hear, both maybe why you did that, but also what it does.
Sure. So within my role at AWS, I lead Fintech for the startup business development team. And so what that means is it's thinking about how can we help make sure Fintechs are building the best products, getting the right services from very early stages all the way through their journey as they scale and ultimately IPO or just become much larger companies. And so one of the opportunities that we really saw is clearly we're very strong in technology and infrastructure, but how can we do more? What can we do more for our customers? And we're always looking around sort of corners to see kind of where else can we be helping or what are some pain points we can solve. And I think the biggest thing I hear from companies is looking for support on go-to-market, like how can you help us win customers? And so we have what's called the AWS Partner Network, and that's really a way that we think about kind of having a more holistic relationship with our customers and driving real business value. And so that means looking for selling into joint customers of ours, helping them with kind of awareness, whether it's webinars and speaking opportunities and sort of just ways that we can do more with our customers. And so that was created a number of years ago. I think where we're seeing kind of a new push there is in the verticalization of that program. And so we have a large financial services organization. And so we work with partners with deep expertise in capital markets and payments and banking and insurance. And then even horizontally, that's all across those. So I think bringing that expertise has been very important. And as a technology provider, I think historically, we haven't necessarily sold as much into line of business. And I think that's also kind of a key thing we're seeing is working with our large financial institutions and customers around solving real business problems and solutions and being able to kind of have a suite of partners that can really engage with the larger institutions. And so that's some of the stuff that we're thinking about with respect to how we're supporting partners.
A side question for you, which we hadn't planned, so hopefully nobody minds. Who leads the sale? Does the firm go in? Do you go in? Is it done jointly?
Yeah, so we have an entire partner team. So a lot of my job is looking and talking to fintech companies and thinking, okay, who is either really relevant or has a solution that we know we can introduce to our customers. Right. So it's a lot of kind of just talking to companies, letting them know it exists, and then it's up to them to really sign up and register, and we really put as much work into it as our partners do. So if they see the value in partnering with us and going to market, we do that. We also have what's called the AWS Marketplace, and that's really essentially an Apple store for software that customers can go on and then easily sell and reach thousands of our other customers. So that's also an area where we're seeing a lot of our fintechs and other companies list solutions and sort of leverage the huge ecosystem that we have.
That's great. Thank you. Brian, you're in a business development role as well, but maybe slightly different. Happy to hear you describe that and maybe the similarities or the differences would be great.
Sure. So Blend is a white-labeled point of sale for mortgage and consumer banking products. So we've got over 200 lenders on our platform. We're very proud to have Wells Fargo, U.S. Bank, SunTrust, Citizens, through to like community banks and small regional lenders as our customer. And we provide the digital experience that the borrower goes through to get a mortgage, to complete their application, and the digital experience that the loan officer utilizes to interact with the borrower. And I think around partnerships, one of the things that we've experienced and benefited from is kind of what Mike was talking about, which is the recognition of these particularly large institutions, large financial institutions, that technology isn't necessarily their number one competitive advantage, meaning that they can want to partner with small companies or young companies or fast-moving companies to provide technology to them and really allow them to maximize their competitive advantages. So if you think about mortgage, a lot of our customers may have an advantage in pricing. They may have an advantage in offering unique products or a diversified product base. They may have an advantage around customer service or existing customers. And so they're able to partner with us. We can provide very quick, very cost-efficient technology, roll out very fast, and provide a phenomenal borrow experience for the customers.
I'm going to ask the whole group, actually. It'd be interesting to hear. So we heard about business services. You just described some, but we also hear the digital experience for the consumer. And I'd be interested in how you view that aspect. Is that a leading reason to move? Is that a primary thing that you look at during the partnering process, if you will? So that's really open for anyone to discuss.
As the token banker, I'll start. Yeah, digital's...
This is like an RFI. You get like a free moment here to put a spec out.
Right. Yeah, digital is extremely important. Obviously, it's where our customers are. They expect it, and I think that was something we realized in certain areas of our product sets. We weren't as advanced as we probably should have been. So we had an opportunity to kind of leapfrog into much more of a digital-friendly experience than we had. Personal lending is a great example of that. Some other products were a lot more advanced in our digital interfaces with them, but still needed tweaks to them. We had a good upfront digital experience, but we didn't have a great experience in the middle and at the end of a customer's journey. So I think digital is important just because that's where everybody expects to be. That said, we still have at TD 1,300 stores across the East Coast, and we get a lot of our customers walking into the store. So our challenge was, how do we make sure that the digital experience that we have on the phone or online can be not so much replicated, but at least matched in the store, so the same information that the consumer is seeing or doing online or on their phone when they walk into the store, 5 minutes later, that store representative, a teller, or CSR knows that. So it's really kind of combining the channels, or the phone channel, et cetera, all together. But digital certainly was something that was at the forefront of our mind.
Mm-hmm.
I want to back up to the first question, and
Sure.
Leads up to this one because it's so important in terms of what's different. I mean, stating the obvious is obviously the evolved technological complexity development, whether from the customer experience, outward facing, from logging on the app, all the way to the actual IT infrastructure that connects all the stakeholders, fintechs, bank partners, and such. And also on the algorithms that both do the credit risk assessment and also the machine learning. So I mean, that's stating the obvious. And I think that has also caused and should cause an uptick in the investment in legal and compliance staff in the industry, as we really rely on the deep expertise of compliance officers, fair lending, attorneys, and that really, I think, sparks an ethical question. And there's two parts to this question. There's the rules of the game and the roadmap, and then there's the bank partnerships as they exist now. And I'm sure we'll get into both. But speaking to the latter, harnessing this technology and using bank partnerships as a model to deliver on mission, is very, there's a tangible way for that to be, for us to be accountable, and that's on the product level. So when we talk about Affirm, which we do point of sale lending to consumers with honest financial products is our mission, the product is the ultimate way, the ultimate kind of bandwidth to hold us accountable for this evolving technology. And I think that's, we're founded in 2012, so we really have the experience to see kind of the last 5 years and where that's changed, to your question. Mm-hmm. And I think not that this question of ethics was absent 5 years ago, but I certainly think it must have to be more prominent as this technology advances and provides more opportunities, especially as a way to hold the industry and ourselves accountable for our mission. And I think that leads into the second part of the digital experience, which we heard earlier about kind of the increased and changing customer demands of a 24/7 seamless experience that connects a variety of different stakeholders into one product as far as the consumer is concerned. So I think the digital experience is key, especially for Affirm. It's one of our main disruptive products in terms of how we create the experience for the consumer. and take a very traditional lending product, an installment loan, and introduce kind of a radical simplicity of transparency and cost of lending in a way that can really be at the confluence of, the next 5 years.
You touched on something in there that actually we wanted to cover, so maybe I'll move to that topic a little bit. Just recently, TD and Avant announced a partnership, and Mike, I thought I'd ask you, what's the process look like, right, from your end? Not so much with Avant, but just in general. And then I'd like to turn to the group because you see the process very differently. The rigor the bank puts into the partnership model, the scrutiny that they need to go through, testing your capabilities, looking at financial service levels, everything else gets into that mix. But I'd be interested in sort of the way TD's looked at bringing on board these types of firms and services.
Sure. Yeah, and the use case that I mentioned before, the personal loans, is a good one. So I joined banking 32 years ago, and I was an underwriter out of college. And the way the bank I worked for gave somebody a personal loan was the customer applied. That in that time it was usually either green screen or actually on paper. An underwriter had to review it. It was probably a 2-day process turnaround time. Then we had to get the customer to come into the branch to sign the documents, and then we'd cut a check. That was in 1987. In 2015, it was the exact same process at TD. So it was an orphan product. We didn't invest in it. So we had a problem, and one other thing that we knew is we had a lot of data on our checking account customers. They were getting personal loans from a lot of other organizations, banks, fintechs, and so we were getting beat in our own backyard, and we knew we had to do something. It was a bit of a kickstart to us. So we spent a year, probably a little bit too much time, trying to figure out if we could do the build ourselves. And at the end of the year, we decided it was way too expensive and would take too long to do, and it wouldn't be an experience that was something that we wanted to give our customers. So we went down the path of looking at partners to do this work with, and had a lot of conversations. That took about another year of sorting through who did what, how did it match what we wanted to accomplish, from the standpoint of we're big on reputational risk internally at the bank. Is it a partner that we wanted to partner with and we could stand up there? Operational risk, credit risk, obviously. So, you kind of winnowed down the funnel down to a few folks, and we landed on Avant because culturally the fit was there, as I said. They had a great experience, and they had a great team from Al on down. Everybody that we interfaced with all along the process was terrific. So the process took a while for us to get there, but the end result was exactly what we intended.
So and I'm not going to put Campbell on the spot, although I could. It was perfect, I'm sure, from your perspective. But maybe using a different example, I'm curious what the third-party process looks like as the person trying to move the product into the bank. And for fairness to you guys, I've lived on both sides of that, and so it's certainly appreciated. It's got a lot. There's a lot to do in that process. Let's leave it there.
Great. So just as a bit of background, Avant is now a 6-year-old company, and about to be 7. And we were much like our Upstart started as a digital lending platform, partnering with a bank and heavily in the personal loan space. And over time, recognized that our technology and our platform would be well suited for traditional banks, and so we created a white label technology platform business, and ultimately we've partnered with a number of banks. TD, I think, has to be number 1 or very close there. Anyway, it's a process that, if you were in a room full of regulators and said it went very quick and very, there were no issues in it, we got it nailed down in a matter of weeks, everyone would be going back to their supervisors and say, look at this very closely. So I think that you're in a very heavily regulated space, which everyone here knows. And so I think that the nature of these things, Avant has definitely gotten better from our end at like understanding what the expectations are and what sort of the key sort of trigger points are. But I think that the nature of becoming a service provider for a major super regional, in the case of TD, I guess that's how you would describe yourselves, and it takes a lot of heft from our standpoint as far as legal compliance and, you know, sort of individual customer line expertise bringing to the table. But from the bank side, and I don't want to speak for Mike or TD or any other customer, but you're moving from a bricks and mortar focus to a digital focus, and so they're inherently processes that are different in one versus the other technologies. So the requirement for the bank to drill down on each of those, because there's just no margin for error is, I think, exceptionally important. And so I would just say that, you know, the process is not quick, but if it were quick, I think it would be problematic. So I think it reflects, maybe it takes, with Avant, we've gotten better at it, so we're able to be more responsive, I think. The turnarounds from our side are faster, but I do think that it's as you would hope that it would be very rigorous. It would be super sort of drilled down on each aspect, and you know, the TD team certainly made us better at sort of understanding, you know, what concerns are and where we should focus and that sort of thing. So again, I think that it's a long process, but in banking, it's such a regulated space, and such, you know, the expectations from the customer standpoint are so high that I think it's, you know, as expected, I would say.
Maybe some of the other firms, you know, I'm interested if there are certain obstacles that you see consistently that you'd love solved, or elements of the process that are challenging. And
I definitely think there's a lot of challenges that would echo kind of the length of time that it takes to go through a procurement cycle and engage with a large bank. One of the things that we've done that's actually, I think, helped move that process along, maybe even accelerate the process to some extent, is by having we have a very strong and well-informed legal and compliance team. Many of them come from different regulators. Many of them are from DC, and that's really enabled us to engage with a lender like Wells Fargo and have an opinion on different regulatory issues, and not necessarily debate it with them, but work through the issue or their concern about something in a much more informed and educated manner. So we've really, as a company, made a dedicated effort to have these people on staff so that we can engage in this way, because there are so many hurdles that you have to go through, and we found that to be reasonably effective.
Mm-hmm.
So I would just say, I know you're suggesting that this really long procurement process is expected. So I would argue that, you know, when you're a earlier stage company, that you can drive real value for an enterprise. These procurement, 12 months of sort of is best case. I think really you're looking at kind of a 2-year process to get involved with one of these enterprises. And I think, you know, a couple of the companies here started as B2C. They were sort of lending, and then they sort of pivoted and transitioned into having a B2B model. And I think when you start out trying to sell into enterprises, I think you know, we're trying to think about how can we help companies get through this process quicker, because it is a huge pain point, especially if you're a company, a startup. You know, you have to worry about having revenue and growing, and you're spending money every day, and these a big POC can cost a lot of money. And so we have what's called a well-architected review, and so we really look at 5 key pillars around security and resilience and operational excellency and cost optimization, and really work with companies to kind of work through their architecture so they're better prepared to go in and have some of those conversations, and making sure, and we have an entire compliance team that works very closely both with regulators but then also with our institutions to kind of make sure we're following best practices, different data privacy regulations in different geos. So we're trying to do our part, but I think there's a lot of work that needs to be done with the financial institutions to kind of improve these processes, because they take forever and they drag on, and the implementation's really long. And so I think there's room for improvement.
Yeah.
Yeah, just mentioning something that Brian had said, for us, looking at compliance, obviously it is a huge priority for us from an operational risk standpoint, compliance and credit. So not only are we evaluating the processes and the systems that a partner has, and we drill down obviously into the minutia on that, but we're also looking at the leadership teams in our partners and the boards and the oversight and looking at their backgrounds. And so, you know, in the case of Avant, we had a partner that was still a startup but had a strong board, had folks on the board that were ex-regulators and senior folks in financial services. And then on the senior leadership team also had folks that had strong credit backgrounds. And for us, that was important from internally selling the story as much as what the end result would be.
So one thing, you know, definitely echo the sort of pre-launch, rigor and effort required. I think one interesting thing we've realized in the process of launching a number of banks is that, you know, as much effort and time goes into the pre-process, it can sort of, there can be almost as many challenges making the sort of joint program successful after launch. And in some ways, I think we're super focused on just getting to this binary moment of launch. And actually, I think the real question is, you have to sort of count the whole timeline from the diligence process through to when the program actually becomes at scale successful. And if you think about the obstacles that go into that, some of the same things that might slow down a process to get you to launch will also cause maybe a bank to have trouble actually, for example, doing the sufficient volumes of, say, digital marketing that may be required to drive sufficient volume to make the program a success. And so one kind of strategy that we developed in response to that was we actually turned the kind of the sort of original direct-to-consumer business that we started out with, we've sort of changed it into actually a referral engine, so that we can, on day one, after we get through the months or years of diligence to make sure that we're all buttoned up for launch, that at the moment of launch we can actually ensure that the program is a success and get sort of real data and volume through it on pretty much a sort of same day basis. So essentially what happens is we have a high volume of traffic on Upstart.com, which serves as a sort of consumer front door, and increasingly to the consumer, it just represents a place you can go to feel assured you're going to get a great rate, especially if, in our case, we do a lot of sort of non-traditional underwriting. So if you don't feel that your FICO score represents you all that well, then you end up coming to Upstart.com. And so we have this sort of huge volumes of traffic there, which we can then immediately send to any newly launched partner. And so we can get someone ramped from zero to, say, originating $20, $30 million a month on day one. And that sort of guarantees that sort of any new partnership will sort of be able to reach scale and start achieving the learning or other milestones that the partner hopes for.
That's great. Anyone else? No? I'm going to switch to the regulators a little bit, but they certainly struggle with this. And, Catherine, I'm just curious if you have enough evidence, because the idea is fantastic, right? You guys learned how to get a baseline through practice and trial and error and repeat business. You're giving them a grid, or if not, an outline to follow. Do you think that's helped or shortened the sales cycle at all?
Yeah, it's absolutely helped, because our customers have come, especially when we're working with larger enterprises, they've come to understand, like, what does that well-architected review mean? And so they're kind of they're more easily able to check certain boxes, and we're preparing the companies to understand how to answer some of those questions, especially as it relates to different, SOC requirements or the services that we offer and sort of how that maps to the bank.
Right.
So I definitely think it's helped. There's room to sort of do more there, but definitely.
Have any of you, earlier panel talked a little bit about what they'd ask the regulators to change, and one of those was sort of a community view. And there are a couple of groups that do that. There's a 3YKP, which is a product for Know Your Third Party. There's TrueSight, which was stood up by the banks actually to vet partners. It's a little bit more post-process, but it's inbound. Have anyone with any experience in some of the quote-unquote utilities that have been stood up to help the partnering, or no? That is a decided no. If anyone wants to, they exist, but they're forming. So let me ask a different question. The regulators do, they have the innovation labs, they have innovation hours, they do road trips, they collect a lot of information from the fintechs because they see the problem you guys are describing. It's hard to sort of get yourself into the banking community. You start to get some leverage through multiple banks, and you understand the process better. So they know there's some gating factors in how they look at it. Is there something the regulators should be doing better? Is there something where, if we only had this or this plus a few things that would really help the whole process?
Yeah, so we've definitely spent a lot of time in sort of various regulatory conversations, starting back to our engagement with CFPB that culminated in the no action letter, but also conversations with sort of all of the many of the other relevant regulators, and generally I think. I think a lot of the banks that we talk to, there's just they don't feel that there's quite enough clarity on sort of what standards exactly they're held to when working with a vendor. I think in some cases it's fairly straightforward. If the vendor is just, say, doing your front end for you, then it's really just a vendor, and it sort of doesn't conceptually change what you're doing. In our case, it's much more complicated because we actually are introducing pretty substantially different models for say underwriting than a bank would traditionally use, and so then it naturally raises some questions like, well, how in depth does the bank's understanding of said model have to be, especially when that model is not the kind of model that they would normally have used, or that or is sort of very, very complicated. There's some of it that may be proprietary in IP, and so there's a whole host of questions like that where I think we've had a sort of very different interpretations of this sort of existing guidance. Everything from just sort of high-level discussions done orally, it may be sufficient to, a bank asking, can you just give me a copy of your entire code base? And everything in between has sort of been...
Turn that over quickly, I'm sure.
Right. So, clearly there's some sort of right place in between where the bank has a sufficient understanding to be responsibly using the technology, but where it's not, getting a copy of the code base. So I think that is pretty... is a question pretty much that we face in every conversation, and I think just sort of there definitely is inconsistency in how it's being interpreted. So I think one thing we definitely love to see is just sort of just more explicit guidance on the sort of right ways to work with vendors, especially if those vendors are sort of deep parts of your process as opposed to superficial ones.
Right. Any other comments, thoughts on the regulatory perspective or regulator perspective?
Yeah, I think Paul hit on a lot of sort of the way we think about it. I do think that the industry has shifted in a way over the last few years from fintech being perceived as this disruptor, and it was sort of fintech v banks, to this idea that they would be partnering, and potentially there would be a real synergy among the traditional banking system and these new entrants into sort of this space, even if it's not specifically the bank, not being specifically fintech banks, but them partnering with banks. I think that regulators have done a lot, whether it's the CFPB or OCC, FDIC, CSBS. They really are spending a lot of time and energy trying to understand the different ways and there's so many models out there, and there's so many different permutations on how the partnerships are being created, that I think it's taken these policy teams time to get up to speed, then you're looking at regulatory guidance or regs, and then you're talking about supervisory staff that is interacting with the actual institution. So there's a lot of moving pieces, and I don't think that happens overnight. But I do think that and I'm sorry, I didn't mean to leave off the Federal Reserve while sitting in Philadelphia Reserve Bank, but I do think that the regulatory community is very focused on the issues and are moving in the right direction. It's not to say that this happens overnight, and frankly, again, it's one of those things that you want more prescriptive and more clarity from regs, guidance, and supervision. But on the flip side, it takes time to get it right. So, I think as we learn when we partner with a bank like TD as an institution, Amount understands more about the relationship, and we're trying to share that type of learning with regulators to inform that process. It doesn't happen overnight. There definitely needs to be a lot more clarity and a lot more sort of, clear lines on what's appropriate and what's not.
I'll refrain from being repetitive, but just to really get on this idea of certainty and guidance as it's important. I mean, I'd be really hard pressed to find any company that's out there touting kind of a general AI unsupervised platform to do credit risk assessment. I may be wrong, but it's generally supervised machine learning algorithms, especially when you get down to the fair lending issues. So I think that refining and fine tuning the discussion of where the guidance is necessary or where it's even lacking, would benefit all of us, especially in a partnership model, because I'm sure many of you all are familiar with the study that came out of Berkeley about the mortgage discrimination case about African American borrowers getting higher rates than their counterparts in similar situations, credit situations. And, as unfortunate as it is, it really is a testament that like ECOA, Reg B, like there is a fair lending platform that is equipped to handle a lot of the machine learning algorithms, especially when it comes to disparate impact. It's when you kind of get outside of that into not only alternative data sets, but into unsupervised learning, which Affirm uses in the fraud detection space, but still as a heavy human interaction point when it comes to identity theft and fraud detection. But making clear lines of where the different types of AI and algorithms are being used and where the guidance might capture it or fall short, I think is huge, is a big part of the details and nuance and technicality of the conversation that is kind of lacking on some of the broader conversations.
Right.
I'm just going to jump in to say we definitely do use these algorithms in underwriting, so guidance there definitely is still appreciated. I'll also just want to note that the Berkeley study, I think is important to know. If you actually read the study, it doesn't quite say what the headlines try to make it say. The headlines are like all of the form. Berkeley study says algorithms perpetuate bias. Actually, the study says, well, first of all, the study, when it talks about machine learning algorithms, is mostly talking about quite simple ones. Ones, sort of, it might consider just using the credit score as an algorithm. Mostly it's talking about automated decisioning. But actually what the study says is that as far as they can tell, the sort of more algorithmic the decision, the more fair it got. And the more traditional the decision making, meaning the more sort of people were involved, the more biased it was. And so it certainly said that, at the end of the day, when lenders were using automated decisions, there were still disparities in outcomes, but they were far smaller than the disparities observed when banks were not using those. Our position, and backed by quite a lot of evidence in a lot of the testing we've done as defined with the Bureau, is that with better algorithms, more advanced algorithms, there are very substantial opportunities to increase access to credit for traditionally disadvantaged groups. And so I just want to put out there that I think there are large consumer benefits to being able to sort of increase certainty on these fronts.
And I just want to clarify, the point of bringing up that study was for the ECOA regimen. I mean, making things a little less racist, I think, is not the promise of tech. So I was very, paid very attention to the discussion on the algorithm distinction. So what I really wanted to hone in on the report, and if you all haven't read it, I do suggest is to really hone in on the need for the kind of the human supervision, both on the front end, and for another panel, that's a whole issue of diversity in tech and kind of the variety of experiences that go into building these algorithms, but also the feedback loop that's required as things get more automated. There's actually more of a touch point for compliance and legal. So that I just wanted to verify that kind of that's what I was honing in on the study to exemplify.
Makes sense. Thank you. Catherine? Yeah?
And just take it in a slightly different direction. I think we've seen sort of the rise of RegTech, which a couple years ago I had never even heard of. And there is, billions of dollars being funded into these companies that are trying to help other enterprises kind of deal with the ever-changing regulatory environment, specifically when you think around sort of data privacy. So there's a GDPR in Europe, and now the California Consumer Protection Act, and will there be other different regulations amongst the states? So I think there is an opportunity for some sort of clarity, like within the U.S., because I know companies are really struggling with kind of how to both comply today, and then how is that going to evolve going forward. So that's an opportunity we see.
Right, certainly. So I'm going to shift gears slightly. We've partnered. We decided to Byverse build in some cases, stay building in others. What do the firms learn, and what do the banks benefit from through these partnerships? Are there ways to expand your business model? Certain things you learn as you get closer to the banks that you can apply back in. And I know two of you at least have relationships outside. There's a Walmart relationship. There's a Freddie Mac or Fannie Mae type relationship. Be interesting to know what you're learning, what then accrues, if you will, to the bank. We'll see if Mike will confirm that for us during the discussion. So,
if you don't mind, I'll go first. So early on in the relationship with Avant, and we quickly realized that they could bring to the table a lot more interesting things from a customer experience standpoint across our bank. So that was one thing that we were really focused on, is where else could we partner with Avant, and maybe on other products unrelated to lending altogether. And so that was kind of the interesting thing for me within our organization. You've got something when you get a lot of other folks around the table getting excited about something you launched yesterday. And so that was an interesting piece for us to determine. So it's all, like I said, it's all about the customer experience and where we can make that much better, much faster, test things, throw things away. We are a better bank for it, and we started to realize that we're very slow with our legacy systems and our legacy thinking. So,
what about the firms? What do you learn? What do you get? How do you parlay that, if you will, into enhancements for the rest of your business?
So one of the things we've done is we work very closely with our customers, but we really fundamentally want to change the way mortgages are originated and to change the process that you have to go through to get a mortgage. So at Blend, we really looked early on kind of at the whole ecosystem of players. And yes, we can work with our lenders, but if you look at the Fannie Mae and Freddie Mac represent 40 to 50% of the mortgage market. So we very early on engaged with them to try to figure out what we could do together to improve the process. And I spent a lot of time in DC knocking on doors, trying to get someone's attention to listen to us, to really work on this. And so one of the things that has transpired over the last few years is there's data validation programs that have been put in place. Fannie Mae has one called Day One Certainty. Freddie Mac has one called AIM. And what this does is it fundamentally changes the process. It really moves from a document-centered world to a data-centered world. And I'll describe how the process has changed. And we've been at the center of this, and our great distribution vehicle, a great way to access data for Fannie Mae and Freddie Mac. So we've partnered together to do this. So traditionally, you'd have to, as part of the mortgage process, submit your bank statements, your brokerage statements, pay stubs, and someone would have to take those documents, those PDFs, read them, input them to the loan operating system. Someone then needs to review that information. And all along the way, there's the chance for human error to fat finger something and mistype it. Or even worse, there's a chance for misrepresentation or fraud. And so working with Fannie Mae and Blend, going through the Blend experience, what we do is you are able to connect to your brokerage account, your bank account, and we draw on all of the data. You don't have to go find PDFs. You don't have to upload those PDFs to a system. You simply enter your banking credentials. We get all of the data. We then, with the lender's consent and participation in this programs, send it to either GSE, and they validate it, and they run it through their own algorithm to give eligibility for assets, income, and employment. And by doing this, it removes the need for the lender to collect any documentation. It removes the need for the lender to have any review around this. It's validated with a positive response from Fannie Mae or Freddie Mac. And so this has taken anywhere from 5 to 7 days off of a 45-day process. Blend is the only point of sale that is certified by Fannie Mae and Freddie Mac to offer these programs. There's other data vendors who do this, but we're the only point of sale that has this embedded in our process. So through this, it took us about 1.5 years to get to green light and go time. We really learned a lot, and we really were highly engaged with them. And we learned a lot, not just from a technology perspective, but from a compliance perspective, a regulatory perspective as well.
Other things you learn at maybe one client that are helpful for the totality of the business, or for the next client would be kind of interesting.
I mean, for Affirm, the partnership model has really enabled us to have an impact in, three discrete spaces. So for customers, for merchants, and some of the implications for the broader market, outside of that. I mean, for merchants, we work across a full retail spectrum from big box stores and national chains all the way down to local businesses, over 3,000 merchants. So it allows us a platform to build and kind of spark small business growth all the way up to big box stores, which has a really significant presence in providing a low-cost alternative to high-cost lending or predatory lending, especially when you look at the slice of consumers of LMI backgrounds that can shop, at brick and mortars as opposed to going, online to, payday lenders. We look at Affirm's technology provides a seamless experience. You look at the product, and it's, a third of our book is 0% APR. The average of the rest is 17%. So you really have a seamless, customer-friendly alternative to high-cost lending, which has a big impact on LMI communities when you talk big box stores, all the way up to retail spectrum, to really just empower small businesses. For consumers, as I said earlier, just kind of holding ourselves accountable to our mission of honest financial products, it provides a radical simplicity in doing this comparison between how much things cost when you want to take credit out for it on the installment loan platform. So working with the bank partnership model allows us to have that really a variety of impacts across customer, merchants, and the broader industry. And I think it allows us to scale our mission, to scale our products, our platforms to an extent that would be impossible without this model.
Anyone else?
Yeah. So for our answer is a little different. It's sort of learning in almost a more literal way, which is machine learning is extremely data hungry, and that means if you're a very large bank, you could at least theoretically go about building a machine learning model because you have a lot of data. But if you're a smaller bank, that's actually even if you could hire all the sort of engineers and data scientists needed to do it, you actually wouldn't be able to amass enough data to train the kinds of models that would allow you to meaningfully approve more people at lower rates and get lower losses. You actually need to be part of a sort of data ecosystem where you can be benefiting from a much larger pool of data. And so one of the main values that we actually bring to the banks in our system is the sort of advantages of data aggregation that are actually necessary to power the kinds of machine learning models that we use across underwriting, verification, fraud, et cetera. And so it's literally, when I say the answer is literal, I mean that each bank's sort of loans on the platform are helping the sort of overall models get smarter, which in turn help sort of all the other clients.
That makes sense. A question for the group. Is this mic still on? Oh, actually, it's on, but it's not anywhere near my mouth at this point. Do you see any difference? You know, we have one of the large super regionals here. Do you see any difference in this market versus the community market? You just referenced it through the course of how AI can be used, but when you go to partner, does it change? Does the rigor shift? You know, there's so many parts of the community banks, credit unions, mid-sized banks, and so on. Any deltas or differences in how one of those market or segments might approach using a partner versus the other?
We haven't seen so much the main sort of type of variation coming across those lines as so much sort of by, almost in some sense, by the kind of specific regulator that that a bank has, which of course is related to that, but not exactly perfectly. And actually not even just say if a bank is FDIC regulated or OCC regulated, but actually specifically who the people are who are their specific examiner. I think that and sort of their relationship with the examiner matters. And you know, we've had conversations, sort of tri-party conversations with some banks and their examiners, and you know, other banks are of the opinion we do not ever want you to meet our examiner, and nor do we ever want to sort of actively engage them in a conversation about anything, right? And so there's like there's sort of, again, the whole spectrum, and it seems to just vary a lot based on some combination of who the regulator is, who the examiner is, and what their sort of pre-existing relationship with their examiner is.
And just for context, we support the largest banks in the world, and we hear the same thing. It does at some point come down to the examiner in the field and that relationship. So it is interesting, and it's something that I know the regulators work on, especially in this arena, where they're trying to stay at pace and help support the industry's growth and your growth. I'm going to switch gears a little bit. How, the banks are required to really look at third-party and fourth-party risk, right? So there's a direct risk, they're signing up or partnering with one of you, but you have suppliers behind there. How do you think about that? There's a risk and security and maybe cyber question in there, but do you feel that pressure through the review process and the partnering process? Do you see a need to look at sort of your supply chain in a way that's different now than it was maybe 5 years ago, as an example? That's not a mic question. Well, he could probably answer it.
I'll start, because this is a good question, and probably a lot of time, both at Avant and on TD side, discussing this point. I think really what we were had a lot of discussions on were kind of the contractual ramifications of third-party risk. Who owns it? Where does it reside? So it was really kind of largely a lawyer and business conversation for a long time, and where those things get picked up and who picks them up. That's what I found. And we both we knew generally where we needed to land, but the specifics around once you're negotiating something and you're getting into the details and you've got lawyers in the room, it starts to become extremely real, and how you put that together. So I think that was the interesting part that I really didn't think through ahead of time. I thought, okay, we all know what we're doing. Let's make that happen. But as always, it never ends up quite that way. So that, from the bank perspective, that's what I found interesting.
Any other thoughts? So, okay.
There's certainly a lot of a crazy sort of matrix of diligence that goes on. In fact, kind of a funny case was we had one bank in their diligence process really want to go very deep on how we were using AWS and exactly sort of where the servers might be, and and they sort of really were unhappy with servers in certain places and more happy with them in other places. And in the end, we sort of had to try to move some things around. But it's sort of a very interesting thing, because I think it was ultimately stemming from a sort of data security sort of concern, and it was, of course, them doing diligence through us on really a much larger company, of course.
Right.
Yeah, and I would say around, certainly your third-party risk, it's real, and institutions have to be very careful about who they're working with and doing the right diligence. And so, to Paul's point, some of what we'll do is we try to help companies. So if they're running on AWS, which almost all startups are on one of the cloud providers, running on AWS, kind of how can we help them in those conversations to answer those types of questions that they're having. So we try to be, just in any way that we can play a part to kind of increase communication and answer questions around that. We're here to educate and do our part.
Great. Mike, if you don't mind, I'm going to not so much put you on the spot, but in the context of procuring services, we were talking about AI a little bit before, and there's, sort of the data richness is relevant to the outcome and how you decide, who to lend to or not. Do you, as a firm, have to look at AI, or people who are using AI differently?
Yeah, interesting. So we made a conscious decision in our partnership with Avant, and at TD we're a very risk management culture. We don't take risks we don't understand, and ultimately we landed on a place where we needed to own the credit policy, the credit decision, and the modeling around that helped the partnership get through internally. So from an AI perspective, as a matter of fact, 2 years ago, we ended up buying in Canada a firm called Layer 6. They are now our internal AI modeling development organization, and they're starting to develop models for us in the United States in our businesses. So that was, I'm probably the wrong person to talk about that one, because we've made a conscious decision. A bright line was that we would own that.
To bright line it. Yeah. Have just that question maybe turned around. Are you seeing, as you go into firms and try to use or apply your products and they have AI behind them, a different set of questions coming out of the banking institutions around your product?
Yeah. So we in some ways as a firm are very much on kind of the flip side of that, where when we sort of transitioned, we actually haven't transitioned fully away, but when we sort of added the kind of B2B business, there was very much an internal debate that was, well, really, we always knew that the thing we were best at was really the underwriting. We could sort of really make a big impact for banks by completely changing the sort of underwriting outcomes in terms of higher approvals at lower losses, and yet that certainly was a much harder bar to clear with a lot of banks, and actually probably the majority of banks we talk to I think are not ready to make that leap because of various flavors of risk aversion, whether it be in compliance or credit or elsewhere. And so we very much had an internal debate like, well, actually most banks that we talk to would be pretty happy if we just helped, say, automate their workflow or put a sort of prettier front end on the front. And we could offer that service. Certainly we do that, and we think we're not bad at those things. But it would be a real shame, because sort of the greatest value that we can offer to the end American consumer is that differentiated underwriting. And so we made a very conscious, almost opposite decision to draw the line and say, we're only going to work with banks that really do buy into this and are ready to sort of make that leap. And so it definitely is a different conversation. It's a harder one. I think everything we talked about in terms of diligence and sort of the time it takes, you can probably multiply it by 2. And certainly, I'd say you get to the sort of 1 yard line and don't make it across, like percentage goes up. So it comes with a real cost, but we think there are commensurate benefits to justify it.
Makes sense.
Yeah.
Go ahead.
I was just going to echo what Paul said. The other example I would give is, and what I think is like a super core competency for Amount, and something that's driven a lot of our activity with bank partners, is the fraud prevention and detection, and that's something that I think, coming from a digital only perspective, you approach it somewhat differently than if someone's walking into a bricks and mortar, and it's something that I think banks have. It underpins sort of everything we do as far as the digital offerings to large regionals, and so I think that's the type of thing that a partnership can bring to a bank. And I'm not sure this is exactly your question, but it's something that partnership can bring to a bank. And I think Mike was saying, build it or partner, and I think it's the type thing that they see immediate benefit from, and it's the type thing that it really changes the way a lot of different business lines are looking at that issue, and it's something that we've seen the most interest. I think probably of anything we do, it really is like the thing people really gravitate immediately to. I don't mean to speak for our partners, but I do think that's the type of thing that a partnership can really provide immediate pickup for the value to the partnership.
Interesting.
Yeah, I totally agree with what you said around where we're seeing. So there's AI can be used sort of in various stages of, from account onboarding and opening. And so that's part of what we're seeing is in identity verification, fraud prevention, from when a customer goes to open a bank account or start a loan. So we work with companies such as Secure and Alloy that really help kind of use machine learning and additional data sources to both reduce false positives so that you're not re-looking at the same customer and giving a poor customer experience to before approving a potential borrower or customer. We do see a lot of concern with the underwriting with using AIs, really understanding kind of what inputs they're using. So we work with a company called Stratify, and they sort of help companies to kind of say, like, this is what are the data points that are influencing that decision, because I think that's ultimately what banks need to be able to show their regulators is what are the inputs that are happening. So kind of the black box model doesn't work. They need to kind of at least understand what are the inputs. But we're seeing kind of use cases from, all across that to collections and kind of how to better collect and kind of prevent, get in front of the borrowers or know when they might default. So there's so many use cases, and I think banks are just picking and choosing where to start before they get into some of maybe the thornier issues.
Makes sense. So we have about 15, maybe 20 minutes left tops, but I'd be happy to take some questions. So if anyone has some, I think we have one right here in the front. I might have to run the mic to you, actually, if you don't mind.
I have a pretty loud voice. First of all, thank you very much. Michael Gearing from Broadridge. I'd be interested in hearing the panelists' views on the sale of microservices as opposed to more of the end-to-end platform services we've been talking about today.
I think actually this ties into something I was going to say around the third-party risk review. I think we're going to see a platform like Blend incorporate a lot more of these microservices, or in mortgage, there are many integrations that we need to have to provide all the different parts of the mortgage application that are necessary. And I think this probably doesn't apply to all lenders. It probably doesn't apply to all types of vendors. But one of the things that we've seen and we're really moving towards is what we call internally as like under the hood. So bringing vendors, other third-party vendors into the Blend platform and packaging it up as Blend. And what we've done successfully at the vast majority of our lenders is be able to either accelerate or in some cases get through the third-party risk review process a lot faster because we are a trusted party, a trusted vendor to our customer, to our lender. And I'm optimistic that this kind of trend will continue. In things around fraud and identity, there may be a lot of sensitivity there, but why would a lender care who they get their flood report from if Blend can provide the data necessary to drive the outcome, which is getting a mortgage, for them? Why not allow Blend to pick the best-in-class vendor or vendors and optimize that process for them? So I think as fintechs mature and going through this learning process with our customers and this partnership with our customers, learning from the regulators and really understanding all the requirements will allow us to do more things under the hood.
Others? The micro question? Other questions? We have one here.
Hi, my name's Lassie Freeman. I am from zip code Wilmington, which is a coding boot camp in Wilmington, Delaware. TD Bank, you're one of our corporate partners. Thank you very much. This question is slightly off topic, but everyone's mentioned risk, and I know we're talking about regulatory, and that's sort of the purpose. But I've heard very little about tech talent risk. Everything that you guys are speaking about is predicated upon the tech talent to build and develop the types of machines and systems that you're going to need to operate all of this. So we run one of the few nonprofit boot camps in the country where we take regular folks with a high school diploma or a college degree or whatever you have, people who, our average age is 30, so we retool people from the workforce. And in 12 weeks, we turn them into Java coders, and we're just coming out with a new pilot program that'll be starting in February for data engineering, the basics of data wrangling and kind of managing some of that data. One of our obstacles is entering these large firms who have really clear policies on 4-year college degree or computer science degree. You're never going to be able to fill the tech talent with those types of regulations. So internally, how are you restructuring and changing what you're looking for in terms of people to be able to work for your companies and fill this huge gap?
Well, I can start with that. First of all, I would love to talk to you after, because there's a number of initiatives that we're doing at AWS to kind of address that particular issue. I think we spend a ton of resources also on training as well, because one of the big challenges we see with enterprises moving to the cloud is being not familiar with the technology and how to operate. So we do, so with National NAB just recently announced we're training a couple thousand of their employees on AWS. So we're trying to kind of really help with the training and development of our customers and partners. And then we do a lot of work with everything from high schools all the way up on trying to promote people to get into training and coding. We should definitely talk about your program, and then there's also companies like Climb Credit that also do lending, and they sort of help provide very low-cost financing for students taking these courses. I think it's a real issue that all these companies should be thinking about.
Anyone else? Great. So just offline, I'd be happy to talk to you as well. We did some work with the Business Higher Education Forum, and very similar to that work, the Aspen Institute just came out with principles last week, and it takes care of some of the mechanics, like 4-year degrees aren't necessary, BS isn't necessary, BA might be fine, AA might be fine, et cetera. So,
and I'll just quickly add, because at Affirm, one of our big institutional priorities is diversity, both in race, ethnicity, gender identity, and a lot of what we're focusing on and trying to build up that talent pool is earlier this year we've established the employee foundation called Affirm Cares, and a big pillar of that is tech training and community outreach in terms of kind of developing the talent pool on the front end, and that includes a diversity of expertise, of background across all varieties. So this is also something I would love to follow up with you about in terms of taking a very broad and inclusive view of what we mean by diversity.
I'm gonna take that and just turn it a little bit. One of the reasons the firms do go to firms like this is they do get that talent, right? They have a certain expertise, it has a certain capability with inbound or in-house systems, but then they go to any one of these firms and they get this very deep vertical talent. So there is a play there. It doesn't solve the question you just brought up, but it's part of the partnering is to find the right expertise in a concentrated manner. So, other questions? Mm-hmm.
Quarter of them are African American or Latino.
Yeah.
You won't find that in most textbooks.
No. Yeah. Really good. Good. Thank you. Keep up the good work. It's important. Others? Other questions? Somebody? Here we go.
Thank you. Joey Patel, the New York Fed. Just want to pick up on something that Brian mentioned with this move from a document-centered world to data-centered. Something that I didn't hear a lot of discussion around was the risks that come from actually accessing that data directly. So I was wondering to what extent you're relying on screen scraping today, and if so, what you're doing to try to move towards APIs, and maybe for the rest of the panel, maybe some views on how APIs may be used to help with the transition to partnering and really opening up new partnership ideas and opportunities.
I'll start with that. So one of the things that we do and that we encourage all of our financial institutions to do with us, not all of them elect to do this, is open APIs or have a direct connection to us so that we are able to get that data without using an aggregator who may be using screen scraping. So our largest customers have done this, and it's worked fantastic. And we have APIs and a professional services team available to do these projects with our customers so that we can have really secure data. For independent mortgage bankers who are not financial institution and some of our other customers, we utilize third-party aggregators who may have direct connections to financial institutions, but they offer 12,000 connections, right? They don't have 12,000 integrations, I can guarantee you that. So there is screen scraping that's going on. I know that there is a movement and a lot of support for moving to APIs and moving to direct connections in the industry in general and getting away from screen scraping.
Others? It's not my panel, but I'd be happy to talk to you about that offline too. Somebody else? Other questions in the back here? There we go.
Hi, Mike Johnson, Federal Reserve Bank of Atlanta. So we had a lot of conversation around vendor and third-party risk management. You know, one of the struggles as a supervisor and regulator is this trade-off between principles-based guidance or prescriptive guidance. And with principles-based, you get a greater flexibility, but also greater uncertainty. And with prescriptive, you know, reduced uncertainty, but also less flexibility. Should I interpret your conversation today that you want more prescriptive guidance?
No, yeah, right. He doesn't need a mic for that, but I'll repeat no was the answer.
Then stop complaining.
No. No. There is, I'll let, I don't know if you guys want to take that or not. You're free to, so.
Maybe it's safer for the bank not to opine on this one. I just think it's not necessarily prescriptive or principles based. I think it's more that many of these relationships and how examiners think about them are new, and the examiners are not used to thinking about. They're used to thinking about third-party vendors in a different way, and so I think that it's often a lack of familiarity and consistency across different regions. And so when I think we talk about expanded guidance, it's both guidance that envisions these type of relationships and gives clarity that to examiners that these are okay for banks to enter into. And then there's I'm sure, and I'm not my background is not supervision, but I'm sure that there's a commensurate amount of work, ensuring consistency across regions and how they interact. So I think it's more an evolving application in some instances of existing, principles-based guidance, but it really is a lack of that these are new relationships, and it's really how examiners should think about it. And I have a friend in the industry that quotes a bank, and he's here today, and he the banker was talking to one of the regulators, and the regulator asked him how they think about these relationships, and the banker said, well, you tell me how you think about them first. And so and I'm sorry if that person, he may be on a panel later, he may be like, you stole my line, but anyway, I think that's very much encapsulates sort of the push-pull.
I'll hand it to the audience on this one, but our primary regulator is the OCC, and we made a conscious decision when we were talking about entering into a relationship with Avant that we kind of walked them through what we were thinking about, why we were thinking about it before we really got full-blown into the discussions. So it was a storyline that we thought was important to share. Our examiners really appreciated that, and we've had quarterly updates with them and very good conversations around what we're doing, how we're doing it, and things. So I think from the bank standpoint, proactivity seems to have been very well received and appreciated.
I think we have a couple more. I know we have one here. Go ahead. Sorry, Nat, just a second.
Sure. Hi, good morning. Jim Fuchs, Federal Reserve Bank of St. Louis. So we have a big portfolio of community banks in our district. And so my question's around, because we hear from our institutions, smaller institutions looking to integrate a technology solution, that their existing core processors are that's a big challenge for them. And for some of you, I'm curious to how you have worked through that, through kind of legacy core systems as you've tried to offer your solutions to some of the smaller banks.
I don't know how many of you would do that. We'll go through like a Jack Henry or an FIS or Fiserv.
So we do that with respect to consumer banking and mortgage, and that's one of our biggest challenges. It's a big challenge from a technology standpoint, from their release cadence being different to their tech stack being different, and it's a really hard challenge. We have the approach that we have taken, which has worked, which does not mean there are not headaches around these relationships, is to really engage with our customers as our advocates with these core systems. So going independent and saying, hey, let's integrate, let's create a partnership, we've found that to be very challenging. Going with a lender or a group, even just a small group of lenders, community banks, that's where Blend started. When I joined Blend, we had 6 customers, and we worked with our customers and the loan operating systems, and used our customers as leverage to get them to talk to us, to participate, to create a partnership. So we've really created this tri-party kind of relationship because a lot of the core banking systems do not want to engage with fintech companies. And if they do engage, there are a lot of challenges around development work.
Nat, you had a question?
Yeah, I just only wanted to address the very good question about what type of guidance would be helpful, and maybe pose a question for the MLA, Nat Hoops with Marketplace Lending Association. The GAO took a look at the digital lending industry and made a recommendation that more guidance around the use of alternative data and alternative approaches to credit underwriting would probably be the number one benefit that the federal regulators could provide to the banking industry in this whole area, because that's, an area that while there's clearly the freedom to innovate, a lot of banks feel that the supervisors aren't comfortable with the idea of taking on a partner to engage in that process, or aren't sure what they think about using these alternative data points. And so I just wanted to put that GAO report, I think, has prompted a really productive discussion between the different regulators in Washington. And I'm just interested, Paul or Campbell, if there's what you think the impact of some sort of a document that kind of outlines that, yes, there's nothing that prohibits you from using these variables, and using a partner to employ a new process at your bank, and in addition to nothing prohibiting you, you can do so as long as you maintain the compliance with ECOA and disparate impact and so forth.
Yeah, this is definitely a conversation that we've been active in, and we're definitely advocates of the view that there is, I would say, going back to the sort of principles versus prescriptive, I think it's really like, what we're looking for is mostly what I would call maybe updated principles. So not necessarily weighing on sort of where on the spectrum between principles and prescriptive, but having the principles sort of clearly be updated to sort of apply to a world where, especially on sort of the underwriting side, there are some pretty new things going on, where there are just in practice a lot of questions about how the sort of existing principles apply. I think generally, where we think it would be a great place to get to would be to sort of, I think there's some sort of an implicit set of kind of thoughts and tests and questions that sort of underlie the existing framework that's used by most banks for underwriting. Kind of if you think about the sort of credit score system, FICO score, credit reports, like why are those things okay to use? And I actually think if we just sort of ask that question long and hard enough, then we can sort of actually lay out sort of what the things that justify the use of those things are. And if we can lay out those things, and maybe it seems self-evident they've been used forever, but that's not a very good answer, of course. And there is some real better answer underlying that. And if we can surface those sort of principles of, well, those things are okay to use because they're predictive and they're fair, where fair means X, Y, and Z, then we can actually apply those same guidelines to really any type of underwriting model, and sort of not have banks in a situation where they sort of prefer one system only because it's the system that is already there.
So we didn't quite get to the future of partnerships, but we have about 3 minutes left, so I'm going to ask whoever would like to speak to either speak to you what you think the future of partnerships. We sort of took a quick journey back a few years. We're talking about current state. Or if you can't forecast, setting a forecast could be hard. What would you like to see? So I'll open that up to anyone in the next few minutes.
So I'll start. So I think with the move for more and more institutions, it's going to take time, but as they move to the cloud, I think they're going to be better able to integrate and partner effectively. You just mentioned the community banks, or if they move to some of these new cloud-based core systems, so you have Mambu, you have Finxact, community banks can start innovating. I think it's going to just drive it's going to drive more partnerships and more effective partnerships in this space. So that's certainly kind of our hope. I think it's going to take time, though.
Anyone else?
I guess since we're in a regulatory setting and there's been a lot of talk there, you would maybe talk about the future of regulation on it. I also think that to the extent that industry and other stakeholders and regulators can work together to advance mutual understanding, and that sounds a little soft, but of sort of the promise that these partnerships can bring. I think there's benefits for large institutions as well as small. I was going to add on sort of the small banks, community banks. I do think that there is a challenge for smaller institutions as far as application of, they really don't have the bodies to bring to in many instances, an Avant TD meeting to discuss these things, we would have more people in the room than they would have in the institution. So I think that maybe the future would be that these partnerships could move towards there be greater regulatory familiarity, and so maybe more institutions could participate. I think that also the promise of AI and what Paul was saying as far as the comfort level with regulators, I do think that the more that advances, the better, because I think regulators definitely see, like when you talk about what FICO, the predictability of FICO versus newer regimes, they understand the benefits, or our fraud prevention services. They understand the benefit. I guess it's the familiarity and sort of getting comfort with those systems, so that they can advance in a way that the customers are really benefiting access to credit as it expanded, and it's sort of a virtuous cycle that I think it takes time, because these are new systems and they can't just sort of upset the apple cart. But I do think that's the future is really there being a really positive environment for the creation of these partnerships.
So I'm going to end on that and thank the regulators for the questions, and specifically the Philadelphia Fed. This is their third conference, and a willingness to have this conversation is just fantastic. So please help me in thanking the panel as well. You guys are great. Thank you.